If you are a salaried employee, tax season might not feel like a big deal. Your company deducts your taxes automatically from your paycheck every month, leaving you free to kick back, relax, and toss the paperwork aside. Since the government already has its money, you might figure there is no rush to file the actual income tax return by the July 31st deadline. You'll get to the official paperwork eventually. After all, the standard penalty for missing that deadline is just a flat late fee. You pay a small fine, submit the forms a few weeks late, and move on.
We can get them on income tax evasion if we can just show that any of the money from the organization's business is going to.
But treating that late fee like a minor convenience charge creates a dangerous blind spot. By ignoring the deadline, you might accidentally trigger a structural financial penalty that costs you thousands of dollars down the road. If you invest in stocks or real estate or mutual funds, the true cost of a missed deadline is buried deep within the mechanics of the tax code. Missing that July 31st cutoff flips a switch that artificially inflates your tax bills for years to come. That visible late fee is just a decoy. The fine you pay up front is only a fraction of the actual cost, hiding a permanent financial penalty waiting beneath the surface. To see how this hidden penalty works, we need to look at what happens when an investment goes wrong, something the tax code calls a capital loss. This animated chart breaks it down. Let's say you invest $5,000 in shares. There is one strict, non-negotiable condition required to activate this tax shield. You have to officially report the loss on your return before the filing deadline. If you miss the cutoff, paying a late fee later on does not buy back your right to use this carry-forward benefit. Filing a belated return automatically voids your ability to carry forward most eligible capital losses into the future. By missing the deadline, you change the legal status of your investment. You take a valuable tax asset and turn it back into a pure, unrecoverable deficit. Let's look at two taxpayers with identical financial records. Both suffer a $3,000 loss in year one, and both make a $3,000 profit in year two. This split screen shows the difference. In scenario A, the top taxpayer files on time in year one, officially registering the loss. When they profit in year two, the old loss perfectly covers the new profit, resulting in zero tax liability. In scenario B, this taxpayer misses the year one deadline and just pays the late fee. Filing late voids the tax shield, so the loss block crumbles. In year two, their $3,000 gain has no protection. The profit is fully taxed. The exact same financial trades result in vastly different tax bills, determined entirely by the specific date the paperwork was submitted. This penalty affects a wide range of investors, reaching far beyond high-frequency stock traders. You are dealing with these stakes anytime you sell mutual funds, trade equities, or offload a piece of real estate at a loss. There is a common psychological barrier where people think, I lost money this year, so I don't owe taxes, which means I don't need to bother filing. Skipping the filing process during a losing year is precisely the moment you throw away your most valuable future tax benefits. Look at tax filing as a self-serving strategy for long-term protection, rather than a mandatory administrative chore for the government's benefit. Keep in mind that capital gains and losses have highly varied tax treatments depending on the exact asset type and the prevailing rules, so always consult a qualified tax professional for your specific situation. The main thing to remember is that the late fee is just a distraction. The true cost of complacency is permanently losing out on future tax savings. Treating the filing deadline with absolute respect is a foundational rule of smart financial management. Earn smartly, save correctly, and realize that a momentary delay today has the power to destroy tomorrow's wealth.